Okay, fun seekers, it's time to explore the most exciting part of bonds. Well, yeah, well, we're going to discuss yield spreads and valuations. And we're going to find out that something looks vaguely familiar and maybe it's a little exciting, but in reality, no, not really. Oh well, oh well. Let's continue. Yield spreads. Remember when we use the term spread in investing, we're often talking about difference, right? The yield spreads are the differences in sector rates that exist among various sectors of the bond market. In general, the shorter the maturity, the lower the rate. The longer the maturity, the higher the rate. Well, that makes perfect sense, right? We're going to discuss that because that's the way it should be. The longer the money is out there, the more there is a potential for things to go wrong. So if you're lending your money, you're going to want a higher rate for longer maturities. The higher the rating of the bond, the lower the interest rate, and vice versa. And this is something that we, as personal financial uh, experience in our personal financial experience, see the better our credit score, the better our rates are going to be when we borrow. Yeah. We'll get a lower rate. And of course, treasuries, because they are the United States government, generally carry the lowest rates. Muni bonds are next, with general obligation bonds paying a little less than revenue bonds. And then corporate bonds being at the bottom of the heap, non callable, paying less than callable bonds. Okay? So here is from Fidelity, which actually has a very good bond website. I mean, I don't have a Fidelity account, so I can't really explore it that much. But it's what they do give you for free is pretty amazing. And these are the spreads between various segments of the bond market. Here are CDs, certificates of deposits, which we find are pretty darn close to the U.S. Treasuries for 3 month, 6 month. And then even when we go out to 10 year or so, they're about the same as U.S. Treasuries. And there's those strips you researched in Chapter 8. They strip away the interest payments from the principal payment and sell them separately. And they're just a little bit higher than the U.S. Treasury, but not much actually. This one's a little less. But over here, you see just a tiny tad bit higher until you get out to the still pretty low spread. And then corporates are going to pay more, but notice that there's a few corporates that are actually paying this one, right? The 2 year AAA is actually paying less than the Treasury. And then as you get lower in credit rating, AA, triple B, you find that you pay more because the credit score is not as high. And then muni bonds, wait a minute, we said muni bonds pay more than treasuries. How come they're paying less? Well, that's because you have to do the taxable equivalent yield to really get a apples to apples characterization. So for people in the higher bracket, in the higher income brackets, it turns out it's higher than treasuries. And then there are some municipal bonds that are taxable, but that's if you are eligible for the alternative minimum tax. Well, we'll just ignore those because most of us are not. So this is a pretty cool little resource that you can use for your Chapter 8 assignment, which I told you in Chapter 8, because there they all are. There are all the spreads, and we're going to ask you to calculate the spreads between treasuries and corporates and treasuries and muni bonds. Often investors will speak about the bond spreads, as being tight or wide. A tight spread means the interest rates amongst the bonds they are evaluating are very close to one another. So let's say you had treasuries paying 4.8 and corporate bonds paying 5.1. That's 30 basis points. I don't know. Basis points. Can't you just say 0.3%? I don't know. I didn't make this up. All right. A wide spread means there's a big difference between the bond interest rates. Treasuries paying 3.2%, corporate bonds paying 8.2%. That would be 500 basis points or 5%. The turmoil of 2008 and 9 spreads widened to their levels not seen since the Great Recession. but they narrowed significantly during the 2010 and have somewhat widened, but they're still pretty small. The yield spreads. If you go back to the previous slide, you'll see that there's a little bit of difference, especially when you get into the triple B. But no, they're all very, very, very tight right now, in my humble opinion. So why take that extra risk for a corporate bond at AAA, AA? Why just get a treasury? But I'm not a big bond fan, so actually I don't know. I don't even own any bonds, just through a mutual fund, and even then I don't really. It's my black sheep of my family. But I have some balance funds too because I'm old. Oh well. Slide 23. The yield curve is a graph that represents the relationship between a bond's maturity and its yield at a given point in time. So there's a curve that shows, it's going to take that data that we saw in a couple of slides and plot it. It's used also to make comparisons among different types of bonds. Now, typically we will see that the yield curve is upward sloping, often called the normal yield curve. Longer-term bonds will have higher interest rates than shorter-term bonds. But sometimes, the yield curve is downward sloping, also called an inverted yield curve. The dreaded inverted yield curve. Shorter-term bonds and bills have higher interest rates than longer-term bonds. That doesn't make any sense. How can that happen? Stay tuned. Here are the two examples. Here is the normal. Shorter-term interest rates will pay less, and as you go out the years at the maturity dates, you'll see that the longer-term bonds will be paying higher interest rates. That's normal, the upward sloping yield curve. The downward sloping yield curve is not normal. It's commonly referred to as the inverted yield curve, and it's often a harbinger of bad things. Slide number 25. Why do longer-term debt securities normally have higher interest rates than shorter-term debt securities? Well, there are a few reasons, a few hypotheses that all make sense. The shape of the yield curve reflects investors' expectations of future interest rates. Okay, well that makes sense, right? Because when we invest, we're often thinking about the future. The maturity preference hypothesis, liquidity preference, and that's what we said. Investors are going to prefer shorter-term securities because there's less time for things to get messed up, and therefore they will require a premium to invest in longer-term securities. And then lastly, the market segmentation hypothesis, which means every maturity date, 3 months, 6 months, 2 years, 5 years, 10 years, they have their own supply and demand curve. And so supply and demand within each of these segments determines the prevailing interest rate. Now, each of these three theories makes sense. I mean, each has some merit. But how do we account for the times when the yield curve is inverted? What factors could cause an inverted yield curve to occur? And what can the yield curve tell us about the future of the economy? Bum, bum, bum. Slide 27. Since World War II, every time the yield curve has inverted, shorter-term interest rates were higher than longer-term interest rates. The economy has fallen into a recession. There was one exception in 1966 when the economy just hit 0% growth. It didn't go negative. It didn't go into recession. It hit 0 and then bounced upward. In 2019, ever so slightly, the yield curve inverted. Now, if you're a sitting president, you don't like to see that. And Trump at 2019 was jumping up and down, screaming at the Federal Reserve Bank to lower interest rates. And of course, that's the worst thing to do, because then the bankers have to say, well, we don't, we're independent. Don't tell us what to do, even if it makes sense that we should do it. But in actuality, it didn't make sense that they should do it. It made sense because we were finally coming out of the depths of, we came out of the depths, but we were finally getting whole again after the Great Recession of 2008 and 9. But then guess who had the last laugh? Stupid microbe. The curve reversed strongly as the virus turmoil hit, And the Federal Reserve Bank slammed on the gasoline again, lowered interest rates to near zero. This happened again in 2008. Starting in 2006 or so, the yield curve was slightly inverted. And so, what is the bond market trying to tell us? Why is it so dangerous to have an inverted yield curve? Well, bond investors are usually far more open-eyed than stock investors. Stock investors have this lots of hope and promise for the future and optimism, and bond investors tend to be called bond ghouls. Why? Well, what happens in a recession? Right, interest rates fall. The Federal Reserve Bank has to lower interest rates to prop up the economy. And the longer term interest rates fall because there's less demand for money, there's less economic activity. What happens when interest rates fall? Bond prices rise. So bond investors are often called bond ghouls for that reason. But, I don't think that most bond investors are hoping for a recession. But if they sense one, they're going to lower the interest rates via their purchasing, their supply and demand of the longer term, and in anticipation of interest rates falling. Because what happens when interest rates fall? Bond prices rise. In 2007, 2006, 2007, 2008, the bond market was predicting a recession for over 2 years. But the stock market, for the most part, just didn't believe him. It wasn't until the fall of 2008 that the officials charged with tracking the economy acknowledged, yep, we're in a recession. But by then, the wheels were ready to fall off. It took over 2 years, but the bond ghouls were finally proven right. Now, for over 2 years now, actually a little bit more, about 2 years, 2023 or so, about 2.5 years. The yield curve has been slightly inverted, and yet we haven't gone into recession. People have been predicting a recession for years, and it just hasn't happened. Are we going to see one? Well, we might see one from the tariff and getting rid of a lot of workers, but who knows? The American economy incredibly resilient, even in the face of the chaos that's going on right now. Amazing, amazing, amazing. We are awesome, and we don't really think of ourselves that way. We just take ourselves for granted, but our economy is the envy of the world. Slide number 28. Here is the yield curve back in 2019. Okay? Well, no. Here's the yield curve in 2019. See how it was slightly inverted right here? This is the gray one right here at the top. Slightly inverted. Shorter term interest rates were a little bit higher than longer term, than 2 year, 3 year, 5 year. But then as you got to the edge of out to 20, 30 years, they were a lot higher. And notice, but these two, this was 2021, the blue, and this is 2020. You see that the yield curves were more normal, upward sloping. Notice how the yield curve was slightly inverted in 2019. Although there was much talk of a coming recession during 2019, many experts were quick to point out that the yield curve could be inverted for quite some time before the economy actually did fall into a recession. COVID-19 came onto the scene and both ends of the yield curve collapsed as the Federal Reserve lowered short-term interest rates back to zero and bond investors braced for a pandemic-induced recession. Who runs the world? The viruses. They've been around for over 2 billion years, yes. We've been around for a couple million. Anyway, slide 29. Here is the current yield curve, and you see it's ever so slightly inverted, ever so slightly. Why? Because investors believe that the Federal Reserve is going to start lowering interest rates, and so they're grabbing onto these short-term interest rates with both hands, because when the Federal Reserve does start lowering short-term interest rates, this is going to become more normal. So much money has been lost trying to predict when the next recession is going to happen. So I don't try to do that. But the bond market's usually right, folks. The bond market is a lot more prescient than the stock market. As mentioned, when the yield curve inverts, the investment world begins to worry about a coming recession. But don't worry about that. Keep a long-term perspective. Recessions come and go. We saw how they're going to happen. We don't know how long they're going to last. Usually it's not that long. We don't know how far down the stocks are going to fall. Usually not that bad. Focus on high-quality companies with growth and income prospects, and whatever you do, don't panic. Yeah, and that's why when you did the Chapter 1 assignment for the CDs, you saw some of the shorter-term CDs were paying higher than the longer-term CDs. Why? Because the banks and the credit unions didn't want to get stuck paying you 5% for the next 5 years if interest rates go down to 3.5% or 3%. So that's why they offered you less money for their 5-year CDs than for their 6-month CDs. Slide 30, bond valuations. Well, we saw that stock valuations are just, blowing smoke, putting your finger up in the air and seeing which way the wind blows. But bond valuations are far more predictable, far more closer to the mark. And we'll see why. Bonds are fixed. We know how much interest we're going to get. We know, barring any default, we're going to get our money back when the bond matures. So yeah. Bonds are normally priced according to the present value of their future cash flows. Does this sound familiar? We're going to get semi-annual interest payments, and we're going to get our prepayment of principal back when the bond matures. Although other factors will always need to be considered, such as the creditworthiness of the issuer. If the issuer runs into trouble, the price of their outstanding bonds will fall because investors will be afraid of default. Go back to Chapter 8, take a look at what happened to Ford, take a look at what happened to the school district of Poway. Ooh, people, basically just said, no, I don't get rid of these bonds. I don't care what's going on. I don't care what price I get. I'll sell them at a discount, a severe discount. And if you had the wherewithal and the courage and believed that the world wasn't going to end, you got some bonds at low prices and very high interest rates. So here's the formula. The bond price is equal to the present value of the interest income and the present value of the repayment. That's the discounted cash flow model, where with stocks we use the dividend as the income and the expected predicted stock price at the end of 3, 4, 5 years. Here we're using, the interest income, which is mandatory. Remember, dividends are not mandatory. They can stop paying you dividends not tomorrow, as the next quarter. So we're going to use the interest income as the income coming in the door, the cash flow, and the par value, the maturity value, the face value of the bond when it matures. Now, we really should do semi-annual compounding because bonds are paying us interest every 6 months. The difference is not going to be that big. So we do annual compounding as if we're getting paid once a year. But we're actually getting paid every 6 months, and then we're getting paid at the end of the other 6 months. And we use the present value tables. And of course, after you've learned how to use the present value tables, we have spreadsheets to make life so much easier. And I sure hope you don't try using the exponential formulas, please. Pretty please. But if you do, good luck, and I hope you know how to use exponents. But it doesn't matter whether you use the exponential formula or the present value tables. Eventually, you're going to use spreadsheets. Life's a lot easier with spreadsheets. Cool? So let's take a look at slide 32. And we scoured FINRA, the Financial Industry Regulatory Authority, for a bond that its price to yield was close to an integer. Why? Because the tables use integers, so it just makes life a lot easier for us. Of course, when we use a spreadsheet, we don't care. The spreadsheet doesn't care about integers. So this bond, due in 9 years, October 18th, 2034, has a coupon yield, a nominal yield. It's paying us 4.875%. That's $48.75 every year. Actually, half of that every 6 months. Its current yield is 4.936. Why? Because the price is a little bit lower than par value. It's rated BBB plus, which is investment grade, very good. I'm surprised Goldman Sachs is not rated higher. And since 5.05% is close to 5%, we're going to use 5% for 9 years. So what's going to happen? Well, we're going to do the same thing we did back in chapter 4, but we're going to have a new present value table. You see the present value table over here on the right-hand side? That's the present value table from chapter 1. I'm sorry, chapter 4, not chapter 1. Chapter 4. That's the one we use for stocks, where we did 1 year at a time. The problem with bonds is you might have 9 years or 20 years or 15 years. If we did that the same way we did in chapter 4, we'd have to do one calculation for every year. But the interest we get every year is exactly the same. So we introduce a new table just to make life easier. And this table on the left is for a stream of payments. You see the difference? See the stream of payments as opposed to the lump sum investment, which is lump sum payment, which is what we did in chapter 4. So what's going to happen? We're going to say, look. We're going to use 5% for 9 years. So for the present value of the interest income, that's $48.75. If we get that for 9 years, that's a little over $400, right? 400 and some dollars. But what is it worth to us today? So we have to multiply it times the present value factor for the stream of income. So that's this puppy right here. We go across the 5%, down to 9 years, and that's 7.108. Okay, so remember that, 7.108? Multiply the $48.75 times 7.108, and at 5% over 9 years, that amount that we're going to get, a little over $400, is actually only worth to us now $346. The present value, $346.5150. All right, that's the income that we're going to get from the bond. But at the end of the 9 years, we're going to get $1,000, assuming the par value is 1,000, and virtually all bonds are 1,000. Some are 5,000, some are 10,000. Let's stick with 1,000. So that is a one-time payment. We're only going to get that paid that once. So we use the table on the right, which is the same table we used in chapter 4. Go across the 5% down to 9 years, and it's 0.645. And you might be thinking, what are these little highlights? Those are for the worksheets and the and the presentation. So let's go over to the worksheets. So let's go back to the $1,000 times 0.645. So you can do that in your head, right? Just move the decimal place 3 to the right. But if you can't, just multiply times 0.645 and you get $645. So that $1,000 we're going to get in 9 years today at 5% is worth $645. So you add those two together, the interest income, the present value of the interest income, plus the present value of the principal payment, and we get $991.52. That's what the model says. Well, on October 27th, the price was quoted as $987.55. Why is it a little bit lower? Just a few dollars. Well, it's not a AAA bond, right? The model assumes everything's perfect. In this case, hey, it's a BBB bond. I want you to knock the price down a few bucks. The bond calculator on the spreadsheet, on the class website, the bond calculator spreadsheet, which I'm going to show you in a minute, gives us $987.63. That's that 31. That's a mistake. I got to get rid of that 31. And $990.91 for semi-annual payments. Why is the semi-annual payment prediction a bit higher than the annual payment predictions? Well, it has to do with the time value money. We are getting paid every 6 months instead of having to wait until the end of every year. So that means the semi-annual model is going to say it's worth a few bucks more. So that's how we use the present value tables. But let's play with the bond calculator. And there's a little presentation you want to play with, but still, it's on the website. It's yours for free. You put in the data in the shaded areas, the name of the company, the coupon rate, the last quote. It calculates the current yield. Put in the maturity date. It calculates the years to maturity. Notice this is the 27th of October. This was due on the 15th, so it's not quite 9 years. So the spreadsheet takes care of all that stuff. And then it's price. You put in the price to yield. It's a principal of 1,000. What the rating is and whether it's callable. You don't really need that stuff, but you do need the price to yield. And then the spreadsheet does all the work for you. So you're going to see the spreadsheet is using exponential formulas. And if you're that excited about using exponential formulas, go right ahead, but please don't. So it's calculating 344.71, which was a little bit less than what we calculated, right? We did 346.515. And for the interest payments, and then it's saying it's 642.91. So that's a little bit less than what the model said using the present value tables. So 987.63. But again, we said we really should use semi-annual payments, which is a pain for us, but very simple for the computer. And it's saying if you get your money, half of your money every year, every 6 months, then the bond is worth a couple bucks more, $3 more actually. Okay, cool, okay. So that's how you use the spreadsheet. And again, I wish you would use the present value tables instead of trying to bang away at the exponential formula. And if you get it right, congratulations. But if you don't get it right, then I have to sit there and explain to you why you really should be using this present value tables, please, because you're going to use the spreadsheets anyway afterwards. Okay, so that's the excitement, folks. That's the extent of the excitement when it comes to bond valuations. Oops. Oh well. So make sure you do now the worksheets, the last problems of the worksheets 1, 2, and 3, and we'll do them. You know, you do there's an answer key and there's a commentary. So you know, yeah, especially number 3 because that's probably what exam number 4 is going to look like. Okay, please. Okay, slide 33. Now let's do some odds and ends here. And here's yet another example of why we want to be long-term prudent investors. What is reinvestment risk? Well, reinvestment risk is the uncertainty about the future value of an investor's bond investments that result from the need to reinvest bond interest payments and redemptions at yields that are not known in advance. Huh? If we're creating a nest egg with our bonds, I mean, if we're just using our income, if we're just using the bond income to live off of, then we don't really care until the bond matures. But if we're using our interest payments and then reinvesting them back in new bonds, we don't know what's going to happen with interest rates going into the future, do we? Right. Changing interest rates don't only affect the price of your bonds, they also affect your future income as you need to reinvest the interest income and bond repayments. If interest rates have fallen, yippee! Although bond prices will have risen, your income level will fall as you reinvest your income and bond repayments. So you say, this is great, my bonds are worth more, but now my interest payments have to be reinvested in bonds that are paying less interest. Ugh. Also, likewise, if interest rates have risen, although your bond prices will have fallen, boo, your future income level will rise from reinvesting in higher paying bonds. You see? Yeah, people just worry about the price, but what about the future income? So yeah, interest rates have risen. Oh, my bond isn't worth that much, but the money you're coming in from the bonds is can now be invested at higher interest rates. Keep a long-term perspective, dear students. Slide number 34. And this is stuff that we really should just kind of gloss over because it's mostly important for people who have a lot of money, like bond mutual fund managers and pension fund managers, insurance companies and the like, or if you happen to be, filthy rich, but then you probably already have somebody, private bond brokers, doing your work for you. What's duration? Duration is a measure of a bond price's sensitivity to changes in interest rates and bond yields. It captures both the price and the reinvestment risk. So we worry about interest rates changing up and down the price, but we also worry about what's going to happen with reinvesting those interest payments and those bond repayments. It's used to indicate how a bond will react in different interest rate environments. The duration of a bond changes as it approaches its maturity date and current interest rates change. In general, the longer the bond's maturity, the longer its duration. Well, that makes sense. Duration, durar. The higher the bond's nominal rate and yield to maturity, the shorter the duration, because then it will be more affected by interest rate swings. The shorter the duration, the less potential price volatility, and vice versa. So now what we can do is add bond immunization. Silly. Investors who have a specified time horizon can use bond immunization to increase the probability of successfully achieving their desired goal. See, the idea is you keep your average duration of your bonds investments equal to your time horizon. So if you got a 5-year time horizon, if you got a 10-year time horizon, you try to hang on to bonds that have 5-year duration or 10-year duration. You would thus be more protected against interest rate induced price swings. But what's the problem with this? It requires constant rebalancing of your bond portfolio, since durations of bonds change as interest rates change and bonds get closer to maturity. Most people who do own bonds, they buy the bond, they used to put it in a desk drawer, but now it's all electronic, and they forget about it. The interest payments are coming in. So who has to use these? Pension fund managers, bond mutual fund managers. Say you buy an intermediate term bond. That means the bond manager is going to make sure that the duration of the bonds stays between about 3 to 5 years, right? Take a short-term bond, it's going to be 1 to 2 years. Long-term bonds, 10 years, yeah, you see, so it's not something we have to worry about. But it's something you should at least be aware exists if anybody asks you about what is a short-term bond fund? What's going on with that thing? What's a long-term or an intermediate-term bond fund? Now, there are 3 basic bond investment strategies. The income strategy, which is the easiest. You buy the bonds for the interest income, and thank you very much. The capital gain strategy, which is the hardest. I just answered the question at the bottom of the slide. Yeah, speculating that interest rates will fall, speculating on distressed junk bonds, rising in credit quality and price. What do we know about speculation? It's the euphemism for gambling. There are people, dear students, very smart people, who are paid tremendous sums of money to incorrectly guess where interest rates are going to go. Can you imagine how much money they could make if they could actually do it? And then the total return is a combination of both. So you'll see the name of a mutual fund, Total Return Bond Fund, meaning, we're going to do our best to juice the returns with some capital gains, but mostly we're here for the income. Or vice versa. They might say income. This is the income fund. This is a very famous one, the Income Fund of America. They also use stocks too, but they're interested in income. And then any mutual fund with the name opportunistic or strategic bond fund, I just stay away from those people. But you decide. Bond laddering, our last strategy here, is basically a diversification strategy, which we're going to discuss quite a bit in a couple chapters from now. Bond laddering is the strategy of purchasing bonds with staggering maturities. You purchase some bonds with short-term maturities, some with intermediate-term maturities, and some with long-term maturities. So you have some diversification amongst your bonds. Again, it's very popular with pension fund managers, bond fund managers, or people who are really, really wealthy, since they have considerable sums of money to invest. So what are the advantages of this strategy? You're diversified. What are the disadvantages of this strategy? You're diversified. Yeah, as we said, in my humble opinion, diversification is a good thing. But there are many people who say, that's for wusses. That's for scaredy cats like Payano. You want to be concentrated. And you know what? We wish them a lot of luck, because what's the question that we asked at the beginning of the semester? Do you want to eat well or do you want to sleep well? And as we saw so far, we're learning how we can eat reasonably well and sleep reasonably well. And wait till we get to chapter 11 when we take a look at balance funds, which are actually a pretty darn good deal, especially when you get older. Slide 38. Here is data as of October 27th, 2021. And this shows the laddering. It's basically the spread, the bond yield spreads that we saw at the beginning of this presentation. You see the 3-month treasury is not paying much at all. Oh no, this was 2021. I'm sorry. This is a mistake. Is this today? I'm getting confused. No, this was 2021. This was 4 years ago. That's right. I'm saying, no, 3-month treasury is paying more than 0.04%. This was before the interest rates rose in 2022. The Federal Reserve had been raising the short-term interest rates, and then when COVID hit in 2020, they slammed on the gas and brought short-term interest rates down to almost nothing, right? And this is what I want. This is what I wanted to highlight. Yeah, let's see. The 2.08. Somebody was buying 30-year treasuries paying 2%. You are guaranteed a loss. Guaranteed. Because if you go back 100 years, inflation's running at about 2-3%, a little over, actually 3%, as we saw back in chapter 1. So you're guaranteed to lose money. Why would you buy those things? And see, a couple of banks, one of them was, what's it called? Silicon Valley Bank. They loaded up on these things. They loaded up on 30-year treasuries. And then when interest rates rose in 2022, because of inflation, now the 30-year treasury is paying 2.45%, and it's eventually going to go up to like 3 or 4%, and they lost their shirts, and the bank almost, I don't know if it did actually go down, but basically, when interest rates rise, bond prices fall. They were using short-term money, which they should have been putting in the short-term categories. They were putting it in the long-term, and then when they had to come up with the cash, they had to sell these things at a huge loss, and they got. And the funny thing is, if you're a banker, folks, you're never going to go to jail, even if you make monumentally stupid mistakes that put people's money at risk and risk the economy. You're always going to just come out smelling like a rose. So lastly, let's take a look at what it is today. Here we are, October 27th, 2025. Now, we saw what you saw just a couple of months ago, right? When you did chapter 1 assignment, that the 3-month treasury, 6-month treasury, actually they've gone down a little bit, haven't they? And they're probably going to go down tomorrow again. The Federal Reserve Bank is meeting, and they're supposed to raise, everyone believes they're going to lower the interest rates by about 0.25%. So we'll see. But notice that the 30-year treasury is now paying 4.757%. So, yeah, do those worksheet problems, the valuation problems, and see what happens when you have a bond that's paying 2%, price to yield 4.57%. Price is going to plummet. And actually, these are a little bit lower than they were just about 6 months ago. So bonds are back. That's what the one bond manager, I heard her talk, and at the end I said, well, can we tell our clients, I can tell my students, are bonds back? And she said, yeah, bonds are back. She was really excited because they lived through almost over a decade when bond yields were really, really low, and then they got obscenely low during COVID, 2% for the 30-year treasury bond. So right now, if you were to put a gun to my head, which, don't do that, and ask me what would I buy, I'd probably be in the, I don't know, I might buy some longer term bonds, but mostly in the 5 to 10 year, somewhere around here. Because you're getting paid quite a bit, not a whole lot more than, well, here, look at corporates, and they're paying, 2 years paying 4%, the 10 years treasury's paying, 4. I probably look at these 2-year corporates, 4%. That's not bad. And 10-year treasury, 4%. Of course, the treasury will pay its debts. Don't let anybody tell you we won't. It's going to get ugly. That's for sure. And income taxes are going to rise. So we're going to have to make some really hard decisions. But the United States will pay its debts, dear students, in my humble opinion. But look, that's not bad. 30-year treasury, 30-year A corporate, 5.82%. That's what we expect over the long term for bonds, 5-6%. Okay, that's enough of that. Slide 41. Thank you very much for sticking with us through stodgy bonds, the boring bonds, reliable bonds. Now, we'll, in the next chapter, spend just a little bit of time looking at hybrid securities. They're not really that popular. They're not that important. But if nothing else, if somebody comes up to you because now you're the investment guru and says, but don't I really want preferred stock instead of just common stock? You're going to say, no. You don't want preferred stock. You want common stock. And so you can explain them after you understand why. But that's the most important thing, so that they don't wind up buying preferred stock and miss out on all the growth of common stock. Thank you so much for being in our class. As always, we are so proud of you. You have learned so much, and you are now awesome.